Welcome to this explainer. So, if you think about the absolute core promise of capitalism, it's essentially the efficient and effective use of money for the benefit of society. Capital is supposed to flow exactly where it can solve problems and create real value. And right now, there's arguably no greater societal problem in America than the housing shortage. So naturally, it makes total sense that billions of dollars are pouring into housing innovation. But when we actually track those dollars, we have to ask a pretty hard question. Is that capital actually being used efficiently? Today, we're unpacking the wild story of Boxable, a company that recently made a massive $3.5 billion bet on Wall Street to completely revolutionize how we build homes. Keep this fundamental question in the back of your mind as we peel back the layers of one of the buzziest companies on the market right now. We're going to look at the massive influx of cash, the shiny new tech, and then the stark reality on the ground, just to figure out if throwing billions of dollars at a problem is really enough when the system itself might be fundamentally broken. Section 1. A $3.5 billion promise, the expectation. Okay, let's jump right into the massive expectations that got investors to open their wallets in the first place. Back in July of 2026, Boxable officially became a publicly traded company under the ticker BXBL. They pulled this off through a special purpose acquisition company, or SPAC, merger with FG Merger 2 Corp. And get this, the deal valued Boxable at an astonishing $3.5 billion. And this wasn't just big institutional money either. Boxable had already raised over $230 million from more than 50,000 retail investors. Everyday people weren't just buying stock, They were buying into a huge vision to finally fix our broken housing market. And their flagship product perfectly illustrates that vision. They call it the Casita. It's a 361 square foot studio unit that actually comes with a full kitchen, a bathroom, and all your utilities. But the real magic here, the technological hook that drew in all that capital, is that it's manufactured entirely inside a factory and then literally unfolds on site in under an hour. It's an incredibly attractive promise, right? It's basically mass-producing houses the exact same way Henry Ford mass-produced cars. High quality, low cost, and unbelievable speed. Section 2. The delivery disconnect. The reality. But here's where we have to pivot from the expectation to the reality on the ground to see how efficiently this huge influx of capital is actually being used to house people. Look at these numbers from their 2024 internal SEC filings. Despite that multi-billion-dollar valuation and hundreds of millions raised, Boxable produced just 140 casitas that entire year. And it gets wilder. They only delivered 51. That left nearly 400 finished units, which is capital that has already been spent on materials and labor, just sitting completely trapped in their inventory as finished goods. So this massive gap between production and delivery creates what industry insiders call a factory absorption challenge. Think about it purely in terms of capital efficiency. You've got these massive factories with incredibly high fixed overhead costs, but because your delivery volume is so low, that overhead is just eating you alive. It becomes an totally unsustainable burn rate. Instead of capital being used to scale up and deliver homes to society, it's being eaten up by stranded assets, just keeping the lights on in empty facilities and covering executive salaries. It is literally the exact opposite of efficient capital allocation. Section 3. The SPAC capital trap. Evaporating funds. So to survive a burn rate like that, the company desperately needs cash, which is what leads us to their public debut. But if you aren't super familiar with how SPACs are working in 2026, this structural capital trap tells you everything you need to know. Right now, redemption rates for these deals regularly exceed 95%. That means investors who park their money in the SPAC originally pull it right out just before the merger actually happens. A lot of folks just treat it as a short-term treasury bill play and never actually intend to hold the final company stock. So if a SPAC trust has, say, $200 million in it, a 95% redemption rate means only $10 million actually survives to reach the operating company. The headline valuation looks amazing, but the actual cash injection, it's often pretty hollow. Now, to be completely fair to Boxable here, their founders and existing shareholders did roll 100% of their equity into the new combined company. They didn't just cash out immediately on the day of the merger. But as skeptics and financial analysts point out, this SPAC structure might be less about getting immediate funding for operations and way more about setting up a highly lucrative future exit. Once those lockup periods expire, the founders can convert their paper wealth into real liquidity. It essentially turns an illiquid private company into tradable stock at a very generous valuation, regardless of how many homes they are actually delivering to people. Section 4. The regulatory wall. Trapping the inventory. So we really have to ask, why were only 51 homes delivered in 2024? We need to understand exactly why these finished, factory-built homes aren't reaching the thousands of desperate buyers sitting on their waitlist. The core problem actually isn't the technology at all. It's the law. Historically, U.S. housing regulations split into two different tracks. On one side, you have the HUD code. This is a federal standard for traditional manufactured homes, like mobile homes on a chassis, and because it's federal, it preempts local laws. If you build it to code, you can place it, period. But on the other side, you have innovative modular housing, like Boxable's Casita. Because it falls outside the HUD code, it is paralyzed by a crazy patchwork of 39 different state modular programs, plus a bunch of local city and county zoning overrides. This means Boxable doesn't just get one blanket approval. They literally have to relitigate their existence state by state. And this number right here, $48,000, shows exactly what happens when you hit that regulatory wall. In February of 2023, the state of Arizona slapped Boxable with a $48,000 fine and a stop work order. For what? Not because the homes were unsafe, but simply because Boxable lacked the specific state-level modular certification. They were legally prohibited from shipping into the state until they waded through all that red tape. Let's walk through the agonizing logistical maze this actually creates. Boxable has to wait on separate certifications all across the country. Major markets like Texas were only just approved in May of 2026, while places like Florida are still pending. Then there's the dreaded two-permit problem. This is where you face duplicative inspections, once at the factory and then again on site by a local inspector who might not even understand the technology. Add in transport permits for wide loads, crane scheduling, and hyperlocal zoning laws that restrict accessory dwelling units or granny flats, and you have an absolute nightmare on your hands. Capital efficiency is utterly destroyed when a home that takes hours to build takes years to legally place. Section 5. A systemic housing crisis. The graveyard. Now, if this sounds incredibly frustrating, zoom out with me for a second. This friction isn't just a Boxable problem. It is a massive systemic failure of capital allocation across the entire housing innovation sector. Welcome to the prefab innovation graveyard. Boxable is walking down a path littered with casualties. Take Katerra, for example. They were a massive Silicon Valley darling backed by SoftBank, promising to revolutionize construction. Well, they burned through $2 billion, yes, billion with a B, and filed for bankruptcy in 2021, largely because they couldn't navigate the fragmented local building codes and zoning laws. The exact same thing goes for blockable, 3D printed housing communities, and shipping container homes. The technology works, the capital is there, but the legal framework simply cannot support it, forcing innovators to waste millions on duplicative compliance instead of just scaling up. But hey, there is some hope. Policymakers are finally starting to notice this massive capital drain. A March 2026 executive order actually directed HUD to develop best practices for states to re-examine these restrictions. And alongside that, Congress is debating provisions in the Road to Housing Act. The overarching goal here is a huge push to judge factory-built homes on objective safety and performance standards, rather than penalizing them simply for the method of their construction. It's a really heated, ongoing debate about balancing local control and safety against our desperate national need for speed and standardization. Which brings us right back to where we started. Capitalism demands capital efficiency. But as we've seen with Boxable, $3.5 billion valuations and revolutionary unfolding houses don't mean a whole lot if the final product is trapped in a factory or frozen by 50 different state bureaucracies. So I'll leave you with this to consider. Can any amount of private capital ever truly work efficiently to benefit society? Or will we finally have to admit that the American housing crisis is, at its core, a regulatory problem masquerading as a technology problem? Thank you so much for joining me for this explainer, and remember to always keep questioning where the money goes.